Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. While the markets continue to track macro data and adjust their forecast of a rate cut, something interesting is happening in the domestic markets. As per the RBI circular dated January 5th, which comes into effect April 5th, basically requiring an underlying exposure for any exchange traded currency INR derivative pair. Good morning, JK. Apart from the German inflation and the US George data, I'm sure our listeners will be keen to hear your thoughts on this regulation change in India.
Good morning, Swaraj. Yes, that has been the main topic of focus in the domestic market because the uh, proprietary trading or the retail trade in the currency futures market has been uh, on the rise, and it has had a significant portion of the market activity in the currency futures. Although it is mostly intended to help the MSME segment of the corporate as well. But while I agree, excessive speculation can go against the objective of having a stabler exchange rate. uh, Total removal of speculators from the market will also not help in efficient price discovery. I think we need some middle path where limited amount of speculative or retail activities uh, you know purviewed, and that can lead to more balanced activity, and also give opportunity for everyone to express their views on the currency, which in turn leads to discovery of a price for the exchange rate as well. We'll see whether we get some amendment, but right now the impact is a bit high because by 5th January, 5th of April, existing positions need to be unwound, and also the activity level and the volatility will also be lower unless there is some amendment that is brought into force. Now, even as that has been the topic, the rupee, of course, traded in a narrow range between 83.35 and 40, mostly confined to corporate activity. Um, there is, belief that RBI will not be allowing the rupee to move into a new low above 83.45, and they have been seen offering dollars at that level. Therefore, we are seeing the market being confined to a range. Downside is also limited because of the strength in the dollar index, and also the oil prices remaining high. There's a lot of uncertainty about the monetary policy of the Fed. The expectations on rate cuts, swinging between 70% and 60% in the last few days. We will have the non-farm payroll data this week, which can give a better clue on what is likely to happen. Yesterday, we did have more inflation, more numbers from US that confirmed that the economy still has a lot of resilience. We had the JOLTS data, which showed that the job creations or the new jobs were quite healthy. Quits rate was also somewhat higher in the sense that employees are confident of finding better or new jobs. Overall job openings also increased slightly more than what was expected. Then we also had the factory orders data that showed a strong rise of 1.4% after a fall in the previous month. Overall manufacturing activity, as confirmed by the ISM report also on the previous day, has shown that US economy, the manufacturing side is actually improving after being subdued with higher interest and finance costs. So it's looking healthy as far as the US economy is concerned. The reactions from some of the Fed members yesterday also showed that Fed needs to be cautious about cutting rates too soon. So that's what the market was looking at, and in fact, the stronger number as well as the inflation, inflation trajectory led to higher yields. 10-year yield has risen more than 20 basis points in the last 2 days, and of course corrected a bit now. So was the 30-year yield. two-year yield rising much less. So there is a certain amount of premium that is started to be given to longer tenor yields, because we know that US Treasury is a big borrower. So the more issuances coming, and market has I think much less appetite now, with particularly doubts creeping about Fed rate cuts, about how much and how soon they will do it. So these things actually played out in the stock market as well, where we did have some downbeat news from one of the major corporate, Tesla also. So all these things led to markets falling more than 1% at one point of time, all the major indices, of course. And although they did retrace a bit later, it is also been reflected in the Asian markets today. Of course, we also had a very sad news about a big earthquake hitting Taiwan region, measuring about 7.7 on the Richter scale. So not a very encouraging start to the Asian market today, but surprisingly, euro recovered from its 1.0720 lows, despite German inflation coming lower and giving confidence that ECB is more certain to cut rate in June, and perhaps even in May, if today's eurozone inflation also comes lower. So surprising strength in the euro, but yes, I think in a way, you could see some of the data from Europe also improving. Yesterday, the PMI final number on the manufacturing actually came better than the preliminary estimate as well. So we are seeing some nascent recovery signs in Eurozone. In fact, the good data from China is also adding to the positive outlook for the Eurozone economy, which is whose fortunes are quite a bit tied to the Chinese economy as well. So the lower inflation and better growth prospects might be one perspective that the investors are viewing the Eurozone economy, and that's the reason why euro could be preferred or be bought on dips. In any case, structurally, euro is underowned. So the dollar index also could not break the 105 resistance conclusively. And one point that actually keeps the dollar bulls in check is the continued rise in gold, which has hit almost near 2,300 mark now. And gold rise indirectly means dollar is weak, although it is not reflected in many other fiat currencies. At least the gold is reflecting the fact that the investors are preferring to buy the yellow metal rather than the dollar in the face of the current inflationary scenario and the monetary policy, which is at an inflection point. So yes, gold bulls are encouraged by the fact that even if Fed delays the rate cut, there is no way they're going to hike. The policy rates are not going to go higher from these levels. And Europe, UK, and other central banks are on the verge of cutting rates in June. So that's encouraging for gold bulls. And of course, having started this bull run after a long period of consolidation, I think it has some more legs to go towards 2,500. Yes, we have a very busy schedule in the next 3 days. We have ADP report today, challenger job cuts tomorrow, and then non-farm payroll on Friday, Eurozone inflation also today, and we have our own monetary policy decision on Friday, although no change is expected from RBI. Mostly we expect a status quo on the stance as well as on the rates. But yes, market will be waiting to see on any new clues for moving ahead. Thank you.
Thank you, JK. And just quickly summarizing, Rupee traded in a narrow range between 83.35 and 40, despite the fall in open interest we have been observing. And from the US, the economic sense we are getting is that from the jolts and the factory orders data, the labor market, the job creation is still pretty healthy. And on the manufacturing side, the things are improving as well. But the Fed members continue to voice their concerns on a premature rate cut. When we talk about euro and the ECB, the narrative being priced in is that there might be an early rate cut by the ECB as compared to the Fed. That's a narrative which is picking up. And of course, gold has been rising, making new all-time highs. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.